few.
Yeah, I think we're still missing a few. Let me ping them once again to have them hop in. Yeah, I think we're still missing a few. Let me ping them once again to
Okay. Do you want to kick off or you want to wait for a couple more minutes?
I think we can wait for Saneel to pop in because he'll be presenting first on our end. He should be here soon.
Okay.
Okay, Saneel should be hopping in now. He said his Zoom is just loading, and then from there we can kick it off.
Yeah. And Max is joining as well, right?
In progress.
Okay. Hi, Daniel. How are you?
Good.
So we have a few people from other groups actually joining us as cheerleaders and also bring some tough questions. Yeah.
Looking forward to hearing all their tough questions.
Yeah.
Looks like we still don't have Saneel in. He's oh, there he is. Sweet. Great. Looks like we can get started then.
Okay. So I'll hand over to you. Okay, Rodney, do you want to get it started?
Yeah, sure. So thanks everyone for coming in today. As I'm sure you all know, the Bull candidate elections are ongoing, and Martin, who's in the call as well, put up a proposal for everyone to basically explain a DeFi project more in depth and provide some analysis, and then have some time for Q&A as well at the end. That way the people who are voting for Bull candidates can have some sort of information to go off of to understand what kind of candidates they'd like to manage the AladdinDAO capital. So today we have a bunch of people from my team presenting. The order will be Saneel, and then me, and then Adam, and then HC, and then Shuyao, and then Chao, and then Jeff, and then we'll go from there with the rest of the team going afterwards as they pop in. Sharlyn, if you have anything else before we can get started, feel free to pop in. Otherwise, we can go directly into presentations.
Yeah, please go ahead.
Sweet. Saneel, whenever you're ready.
Okay, awesome. Here, let me just share my screen real quick. Awesome. Can everyone see that? Yes. Okay.
Yep.
Perfect. Well, good morning, everyone. Thanks for coming out, and for everyone who's watching this now and watching this later, thanks for tuning in. Yeah, I hope you guys are doing all well. Just wanted to take a bit of your time to talk about talk through how I think about understanding and investing in MEV at the application layer on ETH, and we'll dive into KeeperDAO to that end. So I don't want to assume that everyone's like very familiar with MEV, but I do want to go through this quickly because I don't have a lot of time. MEV is pretty fairly significant and relevant when you're trying to understand on-chain market structure and how orders kind of fly around on Ethereum and the dynamics around liquidity and leverage in DeFi. At the core, the fundamental idea of MEV comes from the fact that transactions are public to everyone in the mempool. When you send a transaction through a node, that just kind of gets sent to mempool, that gets propagated, and everyone can look at that. Plus, transaction ordering is arbitrary on Ethereum. There's no kind of set of rules that that govern transaction ordering. So this can leave money on the table, and we'll see in a minute why. Historically, transactions are sorted by gas fees, so miners will order transactions based on the highest gas. But in past years, certain transaction orders can be more profitable than just taking the highest gas transaction. And we've seen that this idea has only kind of increased with DeFi and NFTs. So what does this mean? For example, if both Alice and Bob see like a liquidation opportunity, like someone's underwater loan on Compound and move to liquidate, Alice might initiate it, but Bob might issue the same transaction with higher gas to capture the opportunity. Now, Bob's a miner that this got sent to. He can just censor Alice's transaction and clear it in his own. And this can get very complex, right? It's not just front-running transactions, but also back-running, sandwiching, and everything in between. So ultimately, the value accrual ends up going to the miners plus the arbitrageurs, if they're not one and the same. And right now, it's more of an arm's use of capital. It's called MEV because it's called miner extractable value, but probably maximal extractable value is a better term. Lots of these searchers or arbs use like flash loans and engage in bidding wars to kind of capture these opportunities. And this can be actually really, really bad UX for the chain because it leads to priority gas auctions, where searchers are competing for a specific arbitrage opportunity. So they keep reissuing the same transaction at a higher price until it cuts in their cost basis. And this is not great for retail users, right? Because this drives up gas fees. If I'm trading on an AMM and I get front ran or sandwiched, right? It's terrible price execution for me. If I'm lending and my lending position is big enough size, let's say I go underwater and I have like 5 minutes and I can recapitalize it anyways, but there might just be a bot that sits on chain and liquidates my loan before I can even do anything. And kind of out of all this, users don't ever end up seeing any actual value from that's being extracted. So there's a ton of MEV on ETH, like quite a lot. It's kind of exponentially grown over the past year and a half, but or over the past almost 2 years, and it's quickly approaching $1 billion. And a large portion of MEV comes from DEX activity. So this means that when I place an order, let's say to buy ETH with USDC, I can get sandwich, which means someone, does that buy, puts my transaction in the middle, and then sells it, which they get to capture free profit on my account. Front run, someone, thinks I may know something more than them, and they buy in front of me. Back run, for example, and this kind of goes within the next one, which is all between dexes, but let's say that my buy moves like Uniswap out of price parity with other dexes. Someone may come in, see that transaction, and put in their transaction immediately after, selling back ETH to the pool, buying it elsewhere. So this is about like 96% of me on ETH today. The other 3% is liquidations, and then a combination of arbitrage and liquidations. And most of that value flow goes to miners and arbitrageurs, but mostly miners. It's like 88% of MEV value capture goes to miners. So what do you do about this, right? And especially if I'm a retail user, how do I get exposure to this? Because I don't want to just have my orders kind of flying out in the open, getting sniped by the arbitrageurs and not seeing ever a dime of that value that created, right? There's a few solutions. You can use a service like Flashbots, which I think a lot of people have heard of. That's great. They've created this Geth client, which is a modification of the normal Go Ethereum client that allows for specific logic around these things called bundles. So searchers of opportunities for arbitrage on chain can submit these bundles, which are groups of transactions with an associated tip. The bundle goes directly to these miners running Flashbots. This is about like 86% of the hash rate today, and then include based on probability and conflict. So you can't have bundles that both say I'm going to buy this at like this certain time, right? But if the bundle is profitable and it doesn't conflict everything, it can get merged in with other bundles, and yeah, that tip ends up going to the miner, gets attributed to their Coinbase reward. And if the bundle doesn't get included, the tip doesn't get paid. So they have their own rules around what they consider profitable and how it gets included. But other builders like Mystex, which does have some relation to Flashbot teams, allow users to kind of take advantage of this in a more retail-friendly fashion. Typically, the people using Flashbots are these sophisticated searchers that know how to issue these bundles on-chain algorithmically via the Flashbots Geth API or via contract. Integrated services like Mystex allow users to do the same, but for DEXs. So if you go to Mystex and you want to exchange, again, USDC for ETH, you actually will see that you don't pay any gas. Instead, there's an associated miner tip that you can set. And when you trade that USDC for ETH, that miner tip gets sent along with that trade as a transaction bundle towards the miner. And the important thing to note about Flashbots is that transactions are hidden from the mempool. They get sent straight to the miner. The problem for the end user, for me or you or for thing, is how do you decide the miner tip, right? When people are searching for strategies on chain, they usually give the miner tip as some percentage of the profit of our opportunities they're capturing. Here, it's less obvious. I think some might check Mystex suggests 0.05, but really, if you're doing that much versus like paying regular gas, it might still only be useful for orders in size. Plus, you're still paying the miner, right? So it's another option. Well, I'm sure people who have been on Twitter have seen the great Eden Flashbots debate, but it is another way of getting exposure to MEV. So you can try and go buy Eden if you want to capture some of the value from MEV. Plus, if you want to get exposure, right? So block producers running the Eden Get client, which is different from the Flashbots Get client, propose blocks that are deemed proper or not based on certain rules to get a combination of like the base ETH rewards plus Eden. And so what the Eden token actually does is that users can buy Eden, stake them. And the more Eden stakes, the earlier in the block that your transaction is like guaranteed to include if it's mined by like an Eden miner that's running the Geth client. And if you have 100 plus Eden staked, you get the same kind of private relay that Flashbots' endpoint exposes, which means your transaction never hits the mempool, so people can't snipe it easily. But there's still problems with this, right? There's unclear rules around good blocks right now. That's, I believe, done by a group of people and it's not algorithmic. It is around 54% hash rate, which is growing slightly, but it does make it a coin toss. And the Eden inflation ultimately accrues to miners. So you're still indirectly paying for protection. You can just bite the bullet. This is probably okay for small trades and positions, but not great. Or you could use protocols with MEV resistance mechanisms. This is generally really good, actually. I've had a pleasant experience using and I've looked into mechanisms behind these. Stuff like CowSwap, batch trading, and hash flow are quite good in their improvements, but there's still some caveats, right? With batch trading, you can always get screwed if someone places an order of large enough size. And with hash flow, while it is MEV resistant, very gas efficient and price efficient, you're still relying on their network of market makers to RFQ. So it really depends on their liquidity. Or you can use KeeperDAO. So kind of why KeeperDAO compared to these other solutions? So when I talk about all these other solutions to mitigating MEV as a retail user, plus getting exposure to MEV in a way that I can benefit from it, they always lack or partially satisfy either being able to route transactions privately around the mempool, being effective for trading at size, plus being very gas efficient, and being able to reverse MEV value capture, right? Redirect that to the end user. KeeperDAO is the only protocol I found that really addresses these by coordinating, a set of factors: users, searchers, other protocols for liquidity, and its Rook token. But before I think we understand KeeperDAO, I want to talk about a non-DeFi platform, which is Robinhood. And we've seen that Robinhood obviously has been really good at getting retail liquidity. For those of you who don't know, Robinhood's a brokerage that users can use. It's feeless, and you can kind of just access it from your phone. They kind of give you like a free stock when you join, and they kind of gamify the experience. So they've been really, really good at getting retail liquidity. They got it down to a science. The reason for this is that it's a mixture of no fees plus gamification plus their payment for order flow model. So instead of charging fees to monetize, Robinhood actually sells the right to see the market orders going through their brokerage to market makers that they have deals with, like Citadel, to let them fill it for the spread instead of sending it out into the world and letting the first market maker fill it. Citadel will actually pay Robinhood quite nicely for the right to this information, and it lets Robinhood monetize. This in traditional markets has led to inferior pricing, but it's also worth noting that in traditional markets, explicit front running, like the way that happens in MEV and sandwiching, is banned. So it's not as worse pricing as users are getting when they're exposing their transactions to the mempool and getting blatantly front runner sandwiched. So why KeeperDAO? The closest thing to an on-chain Robinhood for DeFi is KeeperDAO. So I'll go into how it works, and we'll have diagrams. So bear with the text for a while. There's three main components to KeeperDAO: the hiding game, the just-in-time underwriting, which we call G2, and the liquidity pools. So the hiding game is their order book that I talked about. It's an order book based on 0x infrastructure that enables users to place kind of limit orders that are fillable only by keepers whitelisted in the system. So if I am the user, I go say, hey, I want to buy ETH at 4K, right? If it hits 4K, I put that in the order book, and then maybe someone comes around, sees that, signs it, and we both sign our message on chain, and the trade happens. But keepers are whitelisted in the system, which means only keepers can go fill orders that are placed in the system. Keepers source liquidity from all major dexes, so Uniswap, Bancor, etc., to fill orders. And Bancor actually has a direct integration with KeeperDAO, where users can place limit orders through their front end, and that gets put on the KeeperDAO order book. Yep. And this also enables orders to be gasless plus lower slippage, because you're at the end of the day, you're only signing transactions and your order is getting filled almost directly. So it's very unlikely to get fetched. Just-in-time underwriting, on the other hand, is more for lending and leverage. So lending protocols like Aave and Compound, obviously they have collateral ratios at which your loan goes underwater if the asset of your collateral depreciates in relation to the amount you borrowed. And this allows what G2 lets people do is they let people, it's a wrapper for lending protocols. So you can go open a vault. This is represented by a nice, cute little NFT, and you can move your lending positions to this vault. So let's say I'm lending out, comp on Compound, and I'm borrowing USDC against it. And let's say I'm lending out, BAT on Aave, and I'm borrowing USDC against it, right? This, historically, if I get liquidated on one of those, a person in the mempool, any random bot is going to come liquidate me really, really fast. But here, Keeper actually, if you lend through their wrapper, Keeper has these liquidity pools that they can draw upon, where if you go under, the liquidity pool will actually provide the extra capital before anyone else can. So from the outside of the KeeperDAO system, it looks perfectly fine. It looks like the loan is in good health. But on the inside, whitelisted keepers can actually see that this loan is underwater and liquidate it. And when they liquidate it, part of the proceeds they get from the liquidation actually go back to you as the person who get liquidated. And we have these liquidity pools. These pools are used to provision keepers with flash loans for ARBs and just-in-time underlighting. Well, I say kind of quote unquote flash loans, and they take a fee. This capital must always be paid back, and it's used for priority gas auctions that you'll historically see when bidding up opportunities in the mempool. This is a nice little diagram of the hiding book. It aims to get as many exchanges integrated as possible because that's how you get a lot of nice liquidity. So any partner exchange, you can place a limit order, whether it's like a wallet, any kind of interface, you through a wallet, through Bancor, through Uniswap, and that limit order will get relayed to the hiding book where it'll sit, but it's kind of a private mempool because no one else can access it. And then the whitelisted keepers, and the reason I say it's like Robinhood is these keepers are essentially paying for order flow, and the user is getting a better experience as a result. These keepers can access liquidity from anywhere they want, MMs, DEX, OTC, and fill those orders. And then the end user will actually ultimately end up getting Rook for trading on AladdinDAO, on the hiding book, and the keeper can capture like the MEV profits. And this is just like a nice little interface of how the G2 lending works. So ultimately, why is Rook the actual token to this protocol interesting? Ultimately, like we said, it's really hard for end users to effectively mitigate against MEV, much less get some level of exposure to MEV activity. Maybe you want to go bet that MEV will go up because of PGAs, priority gas auctions. You go try and get gas tokens. Problem is that they have incredibly low liquidity and you can't meaningfully bet on these. Eden, on the other hand, could be an interesting bet, but the value accrual is contingent on Eden Geth adoption and the clarity around block production criteria. It's essentially insurance, right? In terms of like how the dynamics work in terms of placing your orders at the earlier onset of the blocks. But right now, we really don't know what they consider to constitute a good block. Plus, it's kind of a coin toss because Eden Geth only has 50% of the hash rate around. Rook, on the other hand, the way Rook integrates the system is that keepers actually have to stake Rook to capture ARB opportunities from order flows coming through the hiding book or G2. And then that Rook gets credited to users once an ARB opportunity is captured. So users generating order flow, actually get paid for it because it is creating arbitrage opportunities, which is kind of payment for order flow, only it goes even one step beyond Robinhood. Getting paid by the Citadels of the world for the order flow. And it's almost like if Citadel paid Robinhood and Robinhood redirected a portion of those profits back to the user. IMO, this is, in my opinion, this is one of the most interesting and potentially powerful effects in DeFi because it can create a liquidity black hole. User order flow begets more keepers, generating profits because there's just more order flow coming through, which means more Rook going to users, which again incentivizes more order flow. It just keeps on going. It's a very powerful potential flywheel. This is also direct exposure to MEV because Rook is literally the creditation from arbitrage opportunities captured on chain by keepers. It should be highly correlated with captured MEV between KeeperDAO and the rest of DeFi and should not be reliant on hash rate, really just reliant on keepers. And governance is coming soon. So before we wrap it up, I know I've gone on for a bit. This deck is not investment advice of any form. It's purely for research and discussion. So with that out of the way, I will note that the current keeper set is limited. Only one keeper active right now, which is linked to the core team, but more on the way as governance goes live. So there will be more whitelisted. The Rook staking logic is still being entirely fleshed out. And an order book is still an order book. It requires good liquidity on both sides, which means keepers willing to take it, especially once they're getting whitelisted. So there is some level of centralization, right? But it is not the best for long tail assets. It's not good for strapping those. Again, it's DeFi, only fast what you can afford to lose. Contracts have been audited by some absolute legends like Samsung, Consensys, and Pexio, but there's always a tail risk of an exploit, and they're not publicly available yet.
Sweet. Thank you so much for the presentation. Anyone have any questions?
I have a question. I did like a stake ETH in a Rook pool, and yeah, pulled it out like, yeah, you had to migrate, and so pulled it out like, I don't know, about 2 weeks ago. And so I looked again at the project, and I didn't see so much things going on somehow. I don't know. I was thinking it's like it's not finding any traction. Maybe did I miss anything? Do they have been too early, or normally I would expect that something which is used then finds, yeah, it does, yeah, that just, I did just see that the team is still small, and I don't know, how do you see this? Do you
Yeah,
have
so
any numbers? How much is it used, or?
yeah, so just to clarify, you were like curious about like the progress of the project. Yeah, so I think the team, so the KeeperDAO is, split into KeeperDAO Labs and KeeperDAO Core, which are kind of the core contributors, plus the, now the Labs team, similar to like Uniswap Labs that have been brought to develop this. Right now the team's focus is on rolling out the governance for existing Rook holders, because liquidity mining happened earlier in the year, plus the tail end of last year. I think it was a period between, I want to say, November to February, November 2020 to February 2021. There is some order flow going through the hiding book, but like I mentioned, there's only one keeper right now. And the reason being is that once governance whitelisted, they want Rook holders to whitelist additional keepers onto the order book. You can lend through K Compound and K Aave. That did go live at the end of August. So that might have been around 2 weeks ago, right? So if I am lending on Compound and Aave, I can do that through KeeperDAO's just-in-time underwriting system. That'll get credited back. But in terms of the hiding book and integration, there's order flow coming through Bancor, but the core kind of like Rook crediting and the rebate mechanism is expected to go live very, very shortly. They're targeting a mid-September release that should go in like a week or two. But right now you can trade on the order book and avoid getting.
You're close to the community, or why did you pick this project? You know the people, or?
Why did I pick the KeeperDAO project?
Yes.
I thought it was the most interesting way to
Okay.
get exposure to MEV on chain.
Okay.
I think, like I said, if you go
Yeah,
back,
I did, but I didn't research a lot. I just looked at the GitHub repository, and I didn't see a lot of
yeah.
action.
So like I
I was
said,
thinking,
it
yeah,
is
no.
the contracts are not publicly available yet.
Okay. Yeah.
Yes.
Then it's clear. Then you see, normally, yeah, you revisit like you. I have some Rook because I did like liquidity mining. Then I go revisit, and then I look at what's going on, and then normally I look at the code, and then if you see that not a lot is happening, then you think, yeah, maybe they're just
right.
doing other stuff.
No, to your answer,
Okay.
if you're looking at GitHub activity, it's not the best proxy for
Yeah.
KeeperDAO's progress. Those contracts are not publicly available yet, which I did ask the KeeperDAO team through Twitter.
Wow, cool. Yeah, thank you.
Hi, Saneel. I have a question regarding the KeeperDAO model. Basically, I think it's a model quite similar to what these traditional finance guys do, like a dark pool. But I think the problem with DeFi is that basically everything is transparent, right? There's no information symmetry across DeFi. Everything is pricing, from pricing perspective, from capital perspective. You can use flash loan to do any arbitrage or liquidation. So I'm just curious. Do you think that the model actually exists within the DeFi realm for such a dark pool model, where you can actually arbitrage against public information? Everyone has the same kind of access to the information and capital. I just don't understand why KeeperDAO can actually profit from this kind of public information, which is available to everyone, and public capital, which is available to every DeFi participants.
Right. So originally I also wanted to say KeeperDAO's hiding book was isomorphic to a dark pool. I don't think this is strictly true, because in a dark pool, both position and size are strictly obfuscated from everyone, right? When we say that the hiding book is hidden from the mempool, we mean that orders routed on the hiding book can only be filled by whitelisted keepers, right? And how do you become a whitelisted keeper? That's up to governance. But historically, it just means that you have some liquidity reserves and you're not going to act in bad faith, and you'll do the coordination game, right? However, you can still plug into the order book, because like I mentioned, it is based on 0x infrastructure, and still, see those prices and see them sitting on the order book, right? See them sitting on, let's say it's like, I don't know, like 100 ETH at 4K, right? And that information is exposed, whereas in a dark pool, you just wouldn't be able to see it, right? And there's like a electronic engine matching them in the background, right? So I would push back on the idea that there is kind of price symmetry. And then in terms of, should a project like this exist in the first place, where you're routing orders around the mempool? Yes, I think it should. I don't see KeeperDAO as actually too different than, say, for example, me taking a Flashbots transaction, right? And using that. So let's say I decide to do the same trade, right? I want to go to Uniswap and I want to exchange. I want to get 100 ETH at, and let's say it's like trading at like 4K, right? So I'll just buy it at market price. I don't see it as too different from doing that and then using Flashbots to issue that as a bundle, because at the end of the day, I'm paying for order flow, but in this sense, it's a little bit different in that I'm paying the miner to have my order included at the top. Whereas here, I'm getting paid in terms of in Rook tokens to have my order getting arbed by these keepers who are able to do these, and having them figure out how the dynamics of like where in the block this goes. So in my opinion, not exactly one-to-one with the dark pool, but yes, there's a place for this, because right now there's actually not a lot of great solutions for retail users to go and both get exposure to MEV and get some of that value back.
Yeah, I agree. I think actually, if we're talking about MEV, there's another topic, because I think there was a lot of controversy around Eden, because they actually tokenized MEV, and I think there's whole theory of whether MEV at the end of the day should be tokenized, right? Because that's the fundamental part of Ethereum, consensus or blockchain. Yep. So I think there's another discussion whether there should be a token there to actually tokenize MEV, or it should totally belong to something that become an infrastructure, whereas the Flashbolt guys insisted. So I'm not sure that there is sustainable value for some of the tokens involving tokenized MEV, because I mean, even you put a token there, it doesn't really change the fact that that there's still value extraction from the infrastructure, where should be equal to everyone, right? Otherwise, the whole sort of security of Ethereum is definitely compromised.
Yes, I mean, I think you need to understand when having this discussion, there needs to be an understanding of where in the MEV flow that value accrual to the token goes, right? So like I said, in the Eden discussion, it's controversial because that Eden token directly relates to block production, right? So the more Eden I have, the more I can get my transactions kind of sped to the front of the block by Eden producers. But like you said, this can create some unfavorable scenarios around Ethereum security and dynamics, because we're interfering with the actual, or not interfering, but we're interfacing with the actual block production when it comes to the dynamics around Eden MEV. It's good to keep in mind that for something like Rook, that actually doesn't touch the consensus level dynamics of MEV at all, because the value capture of Rook actually just comes from the keepers that are within the system conducting arbitrage opportunities on chain, right? So it's not affecting the security per se beyond, like baseline MEV that would happen anyways, because the value capture of that comes from arbitrage opportunities. So the users, when you buy Rook, or when you're getting Rook as a rebate for trading on the hiding book, or getting liquidated through their wrapper, you're not dealing with any kind of consensus level ordering. You're just getting that value from someone else who used your capital and gave it back to find their own arbitrage opportunities. Which is why, to Martin's earlier point on why I thought KeeperDAO was quite interesting, it's to my knowledge the only service that's doing it like that.
Yeah, I think that the difference is that they actually monetize the ordering opportunity within Keeper's pool. So I think that the next question is, what kind of value can it capture? Actually, if we assume that not a lot of the order book actually within KeeperDAO's network, right? So if actually we assume, of course, all the order books are flowed into KeeperDAO and they definitely keep that value and then they can monetize that. But if actually, some of the opportunities is actually open to the traders or protocols outside of KeeperDAO, then I think monetizing that will be quite a competitive game.
Yeah, I think there's certain benefits to the hiding book. I think one, again, having those whitelisted keepers creates kind of pseudo model where it's in between like hash on Uniswap. Two, they have integrations with a lot of exchanges. They have those coming up that get some kind of the underlying liquidity routed on the order book where you can go place limit orders. Three, like I mentioned, it's gasless and lower slippage. And four, I think that, like I said, you can create a really strong liquidity black hole, to your point, where users use the hiding book, they place a trade, they get a rebate in terms of Rook for any arbitrage opportunities coming. So they're incentivized to continue placing orders with the hiding book versus elsewhere, because this is the only place where they're going to get some of their money back and their price execution might be better actually than they expected.
Okay.
Sweet. In that case, I guess we can move on.
Yep. Sorry about that, Rodney. Thank you.
No worries at all. Saneel, actually, that was an amazing presentation. Thank you so much for going so in depth. Yeah, very impressive. Here, I'll share my screen next. You guys see this?
Yes.
Yeah,
that's fine.
Yep. Sweet. Awesome. So I'll be presenting about a protocol called Kine. And full disclosure, the fund that I work at invested into Kine, and I personally hold Kine tokens as well. This is not investment advice. I'm just a huge fan of this protocol. So yeah, without further ado, Kine is a permissionless peer-to-pool marketplace with cross-margin leverage, synthetic funding, and multi-collateral functionality. And that does sound like a lot, but I'll go into each part of that to really dig into what this protocol actually does. So it offers instant liquidity by like allowing for people to convert between synthetic positions without slippage costs. I'll show more how it works when I share like the screenshots of the protocol, but on top of that, it uses synthetic funding in a way where all trades are executed by allowing for people to provide single asset staking. And in doing so, people are exposed to like protocol debt, and the protocol debt increases or decreases depending on whether or not traders using the protocol make or lose money. And synthetic funding allows for the protocol to cover some of that risk by taking the opposite exposure to trades done on the platform. But at the same time, the debt does creep up a little bit. And I'll go into that more later as well. Multi-asset exposure. So as I mentioned before, like Kine is a peer-to-pool marketplace, which basically means that for anything that has an oracle or a price feed will be able to be traded on this exchange. So not only like crypto or not only like synthetic stocks or things like that, but also potentially like derivatives or all sorts of other assets as well. And it's really going towards being a permissionless for the best in slot permissionless version of like a centralized exchange. It also allows for cross margin for up to 100x leverage on long and short positions, which is probably the highest leverage multiple that exists in crypto right now, given centralized exchanges have been like increasingly limited to like 20 times leverage at the greatest. And so this is definitely pretty interesting infrastructure given that it exists. So how does peer-to-pool work? So all trades are executed at real-time prices by basically looking at different order books or exchanges across the market to see like what the real price of different assets is using like a weighted average. And the staked assets within the protocol are used to like fulfill trades at those prices that are provided by oracles. And so you don't get any slippage costs or anything like that, which you typically see within decentralized exchanges, which is also why decentralized exchanges are, not a super favorable option for things like, bigger funds or larger trading desks that execute a lot of trades. But with the peer-to-pool model, this may be a more attractive option for these sorts of players. And stakers do bear inventory risk. So if you are staking, you have protocol debt exposure, which allows for you to, borrow up to 80% against the assets that you stake. but at the same time, the debt can fluctuate and go up. And while the debt may go up, and you may be wondering, then why would I borrow against my assets? Well, you get like rewarded with Kine tokens. And the reason why Kine tokens could be valuable is that Kine tokens are rewarded with the trading fees, a portion of the trading fees that are realized by the exchange. So in summary, the traders enjoy zero slippage and one-stop market exposure. Kind of like putting this into something that is easier to visualize. So we have traders, stakers on the left and right. So if traders trade on the exchange, have some positions and receive losses, then the debt that everyone shares by like providing assets to Kine protocol, it decreases. And the stakers' debt, essentially, like if they were to pay it all off, they would have impermanent gains. Whereas if traders have trading gains, then the debt price would increase and the stakers would have impermanent losses. That being said, once traders trade with the global liquidity pool, part of the trading fees go towards those stakers. So it makes it worthwhile for them to stake their assets as well. On top of that, there are token rewards for trading on Kine's decentralized exchange. So depending on your trading volume, you could be mining Kine tokens. Also, you can like mine Kine tokens by borrowing against your assets as well. And pool liquidity makes it easier to trade on any sort of asset that has an oracle that can dictate price feeds from alternative exchanges, which may become a problem maybe someday in the future if every exchange starts using peer-to-pool models and looking at each other's order books for accurate pricing. Then maybe we can have a circular reference across the market. But given that peer-to-pool is only really done by a couple of different players within the decentralized exchange space, I don't see this being an issue right now. So I can move into the next part. Here's a screenshot of what the staking interface looks like. So as you can see, there are like available assets at the bottom over there, which have different APYs. The APYs are realized by borrowing against those assets. And so for stable coins, for example, if you were to borrow up to 80% against them, you can use that borrowed money to trade on Kine's exchange and like basically mine tokens by borrowing and also mine tokens by trading using borrowed capital. The debt could still fluctuate given that protocol debt moves depending on whether or not traders on Kine's exchange make or lose money and whether or not all of that exposure is very well offset by the offset mechanisms that Kine has built in. But if you were Ethereum BTC or like Kine or any sorts of other tokens that aren't stable coins, then if the price of the token were to drop such that you have over 100% debt, you would start to get liquidated. And then this is what the protocol's exposure typically looks like. So there's a page to like review the different like exposure that you have to each underlying asset. So as you can see over here, the protocol has like a negative 50K position in ADA. It has like a position in Ethereum, a position in BTC, and it works to offset these positions as best they can to try to reduce protocol debt from moving around too much. But you can definitely see what you have exposure to through that protocol debt as well. This is what the exchange looks like. So I mentioned earlier that it has cross margin. And what that means is you can basically cover your leverage across your margin accounts instead of just using isolated margin on the play that you're making initially. The way it does that is while you can use like MetaMask to interact with like the staking of the protocol, in order to trade on the exchange, you deposit into another address that you can use to trade on the exchange. And then you can't withdraw if you have an open position or anything like that to basically ensure that you can use leverage in a decentralized way. They do have like several trading pairs. I have a slide afterwards that goes into exactly how much, but it's a pretty interesting experience. And as I mentioned, also you can mine protocol tokens by trading on the exchange to incentivize more volume as well. So here's what Kine looks like so far. It launched in around March of this year. All-time volume updated for July of this year is around 10 billion so far. And the fees collected every 30 days is sitting around $1.2 million right now. The TVL is at 35 mil. The highest volume the exchange has ever seen so far is $300 million. And it has around 6,500 daily traders. And I think this is where the real meat comes in. A lot of these different data points haven't been up to date since the end of July, because this is some research that I've done 2 months ago. But I did update things like the monthly volume and the market cap as well, just to give you a better sense of what's going on. So while Kine's peer-to-pool and Oracle feeds like model for price feeds is unique and efficient, Synthetics actually uses a similar model as well for their price feeds. If you compare the different exchanges, Kine has a lot of users. DYDX probably has a lot more users right now, given that they released a token and like greatly incentivize usage on their exchange. So those numbers aren't up to date right now, since DYDX has had quite a bit of changes over the past 2 months. But that being said, Kine's leverage is still, maximum leverage is still a lot higher than most other exchanges that are out there. And the trading fees are on the low end compared to what we see other players within the same space do. The monthly volume for Kine is actually extremely impressive. It's at $5.7 billion per month at the current trading volumes, which is actually higher than Perpetual Protocol and Synthetics combined. And the reason why this is interesting is because the APYs that you receive by borrowing or staking on the platform are measured in Kine tokens, which are currently sitting at a $63 million market cap. But if you were to use multiples on monthly volumes or things like that to try to guesstimate, what a fair price could be for a protocol like this, if there were to be price appreciation such that the market cap would be more in line with multiples on monthly volume, then the APYs you can get for even staking stablecoins could be pretty lucrative, given that it wouldn't be like 30% right now or like 50% how it's been earlier this year. It would probably be closer to the several 100% APYs. And so this is personally my favorite way of like staking USDC for semi no risk. You still get like obviously the debt exposure, and the debt does creep up. But that being said, the tokens that you get rewarded, even at this current market cap, definitely cover those losses. And if you were to see Kine appreciate in market cap, the APYs that you'd get even on stable coins is pretty ridiculous. So the token, it's used for governance for things like addition or removal of staking or trading assets. You can set different parameters or vote on parameters using the tokens as well. But also, in addition, you can use Kine to earn trading fees that are earned by the exchange. And on top of that, the more you stake Kine, the more governance power you have as well, if you really care about the protocol. So yeah, that's my presentation. Anyone have any questions?
So is this any difference comparing with synthetics? I assume that they accepted multi-collaterals instead of like synthetic, mainly is in ARCx and part of that in Ethereum. Is that a major difference, or is there any other sort of design differentiation?
Yeah, I think that is a difference. I think that Kine is more so going towards being, the best in slot permissionless exchange, whereas synthetics is, trying to create synthetic exposure to derivatives and different assets as well. That being said, those sorts of assets can in the future be listed on Kine exchange as well. Yeah. Martin, I can't hear you.
So do you have like a multi-chain strategy, or is it
Yeah, they do have a
only
multi-chain
mainnet,
strategy.
or?
Yeah, so they're on.
But the
they're on
users here are
Ethereum.
all mainnet. The 6,000 users are on mainnet.
Yeah, I think those are just the Ethereum users, but they do have users on both BSC and Polygon as well right now, and they're gonna likely launch on chains like Kiko as well, and continue growing on different platforms.
Okay.
You know, given the peer-to-pool liquidity model, you don't have to be gated by liquidity that's directly on that chain. So instead of like being limited to, you know, if you were to launch this on like an EVM compatible sidechain, you'd still have the ability to have quote unquote infinite liquidity because you'd still be using oracles regardless of which chain they're on.
Yeah, that's huge. Yeah, you know, liquidity is quite sticky and it's on mainnet, so it's not easy to move. If you are liquidity dependent, it's not easy to move to another chain because you're stuck on mainnet. Which kind of oracles do they use?
I'm not sure exactly which ones they're using right now. I'd have to double check because I did dive into this like 2 months ago, but this is a problem that like a lot of dexes would face if they if you just fork Uniswap on an EVM compatible network, you know, you wouldn't be able to, you know, harness or tap into or use liquidity on other networks right now until someone creates bridges that are actually safe. But given the peer-to-pool Oracle model, it actually allows for that sort of functionality to exist.
Yeah. Okay, thanks.
Sweet. If no one has any other questions, we can go on to Adam's presentation next. Adam, are you there?
Yeah, I just need 1 second, my bad.
Okay, yeah, no problem. Feel free to go ahead whenever you're ready.
I'm gonna have to just give me a sec. All right, yo, can you guys hear me?
Yep. Yeah, I can hear you.
This should be good. Let me share screen real quick. Cool. Can you guys see that?
Yep.
All right, I did my presentation on OlympusDAO. So I actually have a meeting too in like 7 minutes, but I'll go over a little bit on this to go over. So what is Olympus? Olympus essentially is like an algorithmic currency protocol regulating the free floating Ohm token. And the goal of Olympus here is to kind of build this economically secure currency capable of facilitating real world economic activity on par with traditional fiat currencies. You know, so it's kind of like we see it at Olympus, and like a lot of the community members see it as like this modern return to the gold standard. Oh, and quick disclosure, DeFi Alliance is an advisor to the Olympus protocol. I personally do hold Ohm tokens, so just want to put that out there. So some features of Olympus, right? So it has reserves which underpin Ohm by providing deep liquidity and an intrinsic value. And then there's a policy team which regulates the accumulation and allocation of reserves as governed by the OlympusDAO. And anyone can apply to be on the policy team. So the economics of Ohm are actually quite similar to Bitcoin and other traditional store of value crypto assets, but it differentiates itself by offering native yields, which offset the appreciation, not the supply. And so you kind of secure the network through this value accruing bonding instead of kind of value draining mining that's seen with Bitcoin. And, you know, kind of with its ability to influence its own market through treasury reserves when they get big enough, you know, interesting dynamics can, you know, kind of come to play. So, you know, kind of Olympus being a player in its own market means that at a critical mass of capitalization in the treasury reserves, it can impose stability and enable real world economic use cases with price consistency and low volatility. So you can kind of think of it as like the Federal Reserve or the central bank at that point. And so why is Olympus important? Dollar-pegged stablecoins have been, you know, they've obviously become an essential part of crypto due to their lack of volatility as compared to tokens such as Bitcoin and Ethereum. You know, we've all seen the exponential growth charts. And so users are comfortable with transacting using stablecoins, knowing that they hold the same amount of purchasing power. Obviously, that's a fallacy because the dollar is, kind of controlled by the U.S. government and the Federal Reserve, which means that the depreciation of the dollar also means depreciation of these stablecoins. OlympusDAO aims to solve this by creating a non-peg stablecoin called OHM, and kind of focusing on supply growth rather than price appreciation, and then eventually finding stability. So how does Olympus work? The Olympus Treasury is a monetary authority of the OHM market, right? So the Treasury is limited in its ability to mint OHM by its backing constraint. So you must have one USD for every OHM that it mints. So this means that OHM cannot be printed at will. There must be assets behind each token. This is different than pegging to a dollar. And so like backing allows this, like that's why you see this huge premium on the OHM token trading at like above 300, right? Because it's backed by, not pegged by. And so the life cycle of Olympus begins with bonds. So bonds are the mechanism through which the Treasury brings in new assets. There are two main asset types. There are reserve assets, so DAI, FRAX, and these various other, kind of stable coins, and then non-reserve assets. So you got ETH, like eventually you can add Bitcoin. And then these two asset types also have liquidity counterparts. They have the reserve liquidity in the OHM DAI, OHM FRAX, and then non-reserve liquidity in OHM ETH. It differs in that the Treasury can mint against reserve assets, but it can only hold and not mint against non-reserve assets, which is kind of intuitive because the reserve assets are kind of stable coins. So the bonds serve two purposes. They bring in new reserves and they enable profit distribution. For every OHM bought or sold through bonds, there's a profit margin. So the Treasury is either selling an OHM for more than $1 or it's buying OHM for less than $1. And then the spread there is considered profit, and profits are distributed to stakers in the form of new OHM. The system's kind of always in a state of profit or stagnation, and it's impossible for the Treasury to lose money in kind of these operations. And this advantage is enabled by its senior's rights. And so there's this kind of game theory optimal strategy that a lot of users and people who interact with the OlympusDAO ecosystem kind of go through. And that's kind of like, the 3-3 meme or the comma thing, it all started with Olympus. So users can go on the OlympusDAO app and stake their OHM to get SOHM. The current APY is 8,000%, which can be sustained for over 350 days and growing. And again, the sustained extended runway continues to get larger and larger as more and more people bond, because that adds more and more runway. And so before, the APY used to be like over 150,000. And as I mentioned, that policy team that's running the DAO, they obviously want to have the protocol be sustained and healthy as possible. So, through votes and whatnot, the community has decided to drop the APY to 60,000, then to 20,000, now 8,000. And eventually the goal is to drop it all the way down to like double digits. That way that the runway would, be multiple years. So the 5-day rate of return is about 6%. So if you buy and stake OHM in 5 days, you would get 6% of your stack, kind of back in OHM. And then users can also go on the OlympusDAO app and bond various assets to get OHM. So bonding is the mechanism, that I just previously highlighted. There are various options to bond, right? There's the ETH bonds, DAI bonds, the LP bonds, and the bonds vest block by block on a 5-day schedule. Hence why I mentioned the 5-day ROI earlier. And so if it makes sense, it only makes sense to bond when the bonding discount is greater than or equal to the 5-day ROI. So for example, if the discount for a bond is 8%, and the ROI is 6%, and OHM stays at $300 for those 5 days, bonding at 8% is more profitable than staking at 6% for those 5 days. And so now imagine if OHM goes up in price, we're seeing like whales play these games where they'll bond and then we'll have a bunch of dry DAI or dry stable coins sitting on the side. So they'll bond at like $300. They'll get the 8% discount over the 6% ROI, but then they'll also buy a bunch of more OHM at the market to bump the price up, and then more people will buy. So then now OHM's trading at 330. So then their discount is, obviously way more realized. And then there's also like a little arbitrage that you can run where you can claim and stake as you vest. And then the ARB discount is even more. So like the last time I ran these calculations, they could be a little bit wrong now, but if you vest your bond just once a day, so OHM rebases every 8 hours. So every, 3 times a day, you get your 0.5%, kind of little bonus or whatever. If you claim a bond, whatever is claimable, each day for 5 days, so basically 20% of the vested bond, and then stake that. So that's kind of the 1-1-3-3 strategy you see in the title. And then you stake that. So now all of a sudden you're getting these discounted OHM, but then you're also quickly dumping it in right before a rebase to get the 0.5% boost. And then if you do this just every day for 5 days, you end up getting a discount of like 14-15% as opposed to the 8%. So that's like kind of a quick rundown of OHM. Some stats. So as I mentioned earlier, we have the OHM, like the beauty of OHM is increasingly growing treasury. And the idea is for the treasury to become big enough to then become an actor in the market. And so the risk-free value of just in 6 months is about $42 million with DAI and Frax in the treasury. And then that's obviously the risk-free because of stable coins, and then the market value when you include ETH, Sushi, because they own the Sushi pool, so they get a bunch of Sushi for trading fees and onsen, it ends up being about $127 million. The risk-free value one is the one that most people keep an eye on though. And then some other growth metrics, total LP fees, have earned over $2.3 million because they own both protocol and liquidity for 99% for Frax and 99% for Sushi, or the DAI on Sushi, both of them on, and so $70 million of the own liquidity for DAI, $16 million of the own liquidity for Frax. And these are some other metrics. The holders over time has just steadily been growing. The current reward rate runways available for about 350 days, and you can kind of see like when they dropped the APY, right? Like this was, kind of just recently they dropped the APY to 8,000%, and so now it's flatlined, and that's what we're seeing here. So some stats, this is comparing, like these are the stats for the month of June and just kind of comparing them to the month of July in the next slides. So, this is like a monthly revenue. You can kind of see Olympus compared to all the other protocols. And like the revenue is kind of calculated by the amount of capital that's taken in by the protocol measured at, the market value at the time of the acquisition. So in the case of like, Uniswap, SushiSwap, Bancor, revenue comes from trading fees, and for Aave and Compound, it comes from interest. For Olympus, like the revenue comes primarily from bonds and a little bit from trading fees for owning the pools. But so you can kind of see where it compares next to these protocols, and you can kind of annualize it and see that Olympus is, at least for the month of June, the annualized revenue was almost one of the highest in the industry. And this goes back to the users too. That's the thing. And so if you kind of market cap to annualized revenue, you can kind of see how undervalued, quote unquote, Olympus would be placed at. And so that was obviously a great month of June, right? And if you compare that to July, it only got better. The protocol revenue for July was like 35 million. And so annualized, it was, almost $500 million, and the annualized protocol revenue, obviously the same thing. And so these are the same numbers, kind of you're just showing the trajectory, the growth trajectory. And so I think that one of the more important metrics that a lot of people kind of, like we've all famously heard the saying, invest in cults and whatnot. I think that the OlympusDAO community is also one of its key like fundamentals for, when looking into Olympus. Over the past 4 or 5 months, OlympusDAO has seen an incredible amount of growth and some key stats from the Discord. So they have over 15K members, and then a separate DAO server with over 1,500 members that are, extremely active and contributing, a lot of activity in the servers if you guys have ever been. And the people are, extremely active, always willing to help one another. And, kind of, as far as I can tell, they've spent zero marketing budget spent on, influencers and whatnot. So, it's just kind of consistent up and to the right growth for members. Holders and community growth both go hand in hand. And if you kind of benchmark this against other DeFi protocols, so Olympus has, over 15K members and then over 1,500 in the DAO that, kind of all work. Whereas like ARCx, considered to have a strong community, have like, probably close to 10,000 now, Fate protocol has like about 12K, Balance, these, Synthetics has like 30,000, Compound has about 12,000. So just kind of benchmarks it against some of the top DeFi protocols. And so user engagement, this is a cool thing that, we've kind of, I've worked with, with Zeus and a few others to figure out. The community internally figured out some initiatives to, onboard new members and teach people about Olympus, because it's oftentimes discredited as a scam, blah, blah, blah. And so you can kind of see like right here, there was this Sherpa and Grasshopper initiative done, which, we help all of us community members help do in the server. And as new members would come in, the Sherpas would kind of, teach them a lot of the new, a lot of how Olympus works. And then you can kind of see, the activity going up in that direction because of that. And so some of the DAO accomplishments, we've seen the DAO super active, organize events, like execute partnerships, ideate on bonds, did the Rory Infused partnership, Olympus pool party event with, a lot of the other protocols in the same exact kind of niche. And then, many more that, have been coming. So it's amazing to see how active the protocols community and whatnot is. So yeah, that's a quick, background on DeFi Alliance, Olympus, and, kind of from DeFi Alliance's angle. Happy to answer any questions.
Yes, actually, I have 2 questions. One question is that Olympus, it actually is not a US dollar peg stable coin, as most of the other guys out there. I think the problem is actually it's making it more difficult to actually find the actual use case because it's fluctuate. It doesn't peg anything. It's very difficult to use that to do a lot of arbitrage against other stable coins. I think so. So what is the fundamentals of demand for that? In order to create a organic demand, and of course that's important because you need to answer the second question is if actually using the stablecoin as reserve to actually main OlympusDAO's stablecoin. I think it's quite similar to like the PSM design of DAI, where you put in a stablecoin, you can swap one-to-one to Paxo, USDC, etc. But I think that the problem is that in MakerDAO, there's a way to compensate the yields, right? So you put in stablecoin into the vault, you have opportunity cost. I think the cost for stablecoin is about 5 to 8%, depending on different protocols. So for Olympics, how can they actually compensate the opportunity cost for people to put a stablecoin in the reserve to main the underlying stablecoin without, for example, liquidity mining or governance tokens incentive? Because I believe those are really not sustainable, because if actually you grow your treasury, you grow your assets, you have to increase your subsidies to that. And I think from a long-term perspective, it's quite, it's not really sustainable. And the other thing is that if you don't have a user case to support that, given it is not a US dollar pack stablecoin, it's very difficult to find actual use case. And how was the underlying sustainable yield coming from? Yeah, that's my question.
So the yield it comes from the bonding, right? Like the bonding extends the runway, and so more OM can then be minted, and so that kind of gets sent to it. Has like like these are questions that we as the community have kind of, a lot of people have asked. Obviously, I asked early on, and so the quick and short answer, because I'm running a little late for a meeting, but the quick and short answer is as you bond, more and more OM gets sent to the distributor, and so then the distributor then can send that to the people who are staking. And so that's for the yield. With regards to OM, kind of obviously being fluctuating in price, that is kind of the idea is to create a floating currency, right, and not pegged to fiat, because you don't want to be subject to the monetary policy of the Federal Reserve, and we've seen how loose that has been over the last year and a half. And so right now, like Olympus and the community, and most people who have studied the protocol know that right now it's kind of in a growth and expansionary stage. You won't get price stability at like just 1.5 million supply. Obviously, the supply needs to be hundreds of millions of OM tokens. And so by then, like that's kind of the way that I see it. It's kind of inversely related, where as yields continue to go down and as supply continues to go up, you'll see this price stability. And so that's kind of why we have this DAO that's kind of working on bond controlled value and various other things in order to kind of enable, all right, maybe we want to aggressively expand supply for this month, or maybe we want to, kind of not do supply this much this month because we want to cater to making stakers more profit. Whatever the case may be, there's a DAO that kind of handles all of that monetary policy, and knowing and keeping in mind that the end goal eventually is to have, price stability. And so like what does OM stabilize at? Like no one has an idea. It's entirely possible that it could stabilize at exactly what the kind of risk-free value is per OM. And so if it's like $40, $50, then OM would be kind of $50 floating. But that wouldn't matter because by then, like hopefully like people would be used to just using OM as like the reserve pair, and being able to like swap in and out of OM in different situations that are needed.
Yeah, I think for the non-stable stablecoin, I think the problem ultimately is on the mechanisms, right? Because for DAI, it's very simple. It pegged to US dollars, so you have an expectation of interest rate change to actually arbitrage on the price pack. But actually, for a non-pegged stablecoin, the problem is it's totally unpredictable where you want to trade against, right? It could be the price could be anywhere up or down. But there's no peg. So basically, for the arbitrage traders, it's just totally impossible to actually make any trade against it based on logic. But for DAI, this is very simple, right? It's actually above $1. You expect the interest rate to basically drop, or increase, and that's something that you can expect, and you can make a trade on that as well. But for unpegged stablecoin, I think that's a big challenge.
Yeah. I mean, the idea is, we'll see how things play out, obviously, as like OM stabilizes. But the idea is like, if and when OM stabilizes, it's like you have your kind of guaranteed, quote unquote risk-free reward where you're getting 8-10% or whatever for staking Ohm. And then, given like, let's say that the market is looking bearish, a lot of people would, flood in and start staking Ohm instead and kind of use that as their, you flee to Ohm in order to kind of get this guaranteed yield. And then when the market starts looking expansionary again, like, the broader markets in Bitcoin or Ethereum start going up, you would kind of dip out of Ohm and then go and collect, go and try and catch a swing in ETH and Bitcoin and then, throw that back in. And so it's like the idea is to kind of actually have it actualized as this reserve pair where you're using it to, you're coming in and out of Ohm rather than in and out of a stable. And we'll see how obviously that plays out. I'm sure it'll take years, maybe, a lot of months, years for this to even get remotely close to kind of actualizing. But yeah, it's like it's been, I think Olympus has been up for about 6 months, 7 months. And, it's kind of constantly been growing the treasury. The runway has consistently been increasing. And, along with a lot of people saying that, there isn't enough liquidity or it's a scam or it's just a Ponzi scheme. It's been continuously running pretty productively. And so I think that a lot of people are just, I don't know. I think that it's intellectually, like dumb to discredit Olympus. And that's kind of what a lot of people are doing. So yeah, that is just, super interested in the dynamics there. And obviously, like, I don't know if you guys have been around the community, but the memes are super strong and the community is just super fun. So that's also like another, added bonus.
Okay.
Sweet. I think we should let Adam go as he's super late for his meeting. But move on to HC. Thank you so much, Adam.
Yep. Thank you, everyone.
Hi, this is HC. Actually, how do I share screen?
Just bottom in the on the bottom in the middle, there's a button that says share screen.
Oh yeah. 1 second. Wait. Actually, it doesn't allow me to share screen somehow. Yeah, actually, I can just talk it through.
Do you want to send it to me so I can help you to project it?
That'll be helpful. Thanks. You're the best. Sharlyn. I just send it to you on Telegram.
Okay.
Sorry about that. Technical issues.
No worries, it always comes up. We'll get through together.
Yeah. I can kickstart. Sharlyn, once you have it, feel free to open and share with everyone. So actually, the project I picked today is CowSwap. Thanks to I think it was Saneel who went first. Spent quite some time explaining what MEV is, so really saves me a lot of time. And we can directly go to, yeah, we can see it now. Thanks, Sharlyn. So CowSwap is actually MEV minimizing DEX aggregator. So how does it work? It actually runs the off-chain order book that directly matches and settle trades in different directions. So let's say there are two traders, one Alice, the other is Bob. Alice wants to buy ETH with USDC. Bob wants to sell ETH to USDC. Instead of having them to tap into like Uniswap pool separately, like CowSwap can actually match those trades in opposite direction and then bundle them together to let users to trade with each other, and that saves slippage, saves gas fees, saves MEV. So to break it down a little bit more on how the product actually works, there are actually two players in the CowSwap system. One is traders. So like you can think of anyone like you and me, or like big whales who just want to send a big trade on chain. So it actually it only signs the transactions, and then the transaction will actually hand over to the solvers. And what does solvers do? Solver actually have two jobs. One is looking at all the transactions that traders send to them. The other is actually to bundle the transactions and directly send them to the miners. So similar to what arbitrageurs and seekers do in Flashbot case. So looking at all transactions is actually a very difficult job, because you need to constantly monitor what's available in the CowSwap mine pool, which is a separate pool than the public mine pool. And when two traders actually hold assets the other person wants, they call them a coincidence of wants. So abbreviation is COW, cow. That's where the CowSwap name is coming from. And then solvers can actually match those two transactions and bundle them. It is a very mathematical question, because the example I gave, which is the ETH and USDC pair, was the most simple and obvious example. But actually, when some token pairs that do not have direct liquidity between the token pairs, sometimes still need to route through the third token. So like either trading from token A to USDC and then to token B, then like probably you won't have a full cow coincidence of wants, but part of your trading path can hit and bundle with another trade. So that could be just a partial coincidence of wants as well. Sharlyn, if you can scroll down a little bit, there's actually a chart. So if the trade doesn't settle within go back a little bit and down. So if the trade doesn't have any calls within 30 seconds, the trade will tap into like all other liquidity venues like Uniswap, 1inch, Matcha from 0x, or some other market makers. So the solver's second job is bundling those transactions and send them to the miners. The market itself is actually very big. Where CowSwap sits is in the middle of MEV and DEX aggregators. So there are actually two ways to think about it. One is the total MEV value is actually more than 700 million this year. And DEX aggregator, the leading one is 1inch, which is trading more than 500 million market cap, not FTV, but circulating market cap. Sharlyn, we can go a little bit down. And the traction, so since launch, CowSwap had more than 700 million trading volume. It's not great yet comparing to what 1inch has, but like the project only launched a few months ago and still in very early stage. The team is very interesting. CowSwap team is actually built by the Gnosis Safe team, and Gnosis Safe, like Gnosis team was famous for Gnosis Safe product, and they're building more, and the team is very capable, and they're not like lacking any money per se. Like Gnosis, not many people know this, but like they're actually if they disclose it, they're actually one of the best hedge funds in crypto ever, just by trading beta. So the thesis here is one, MEV has gained significant traction and won't go away, because as long as miners have the right to order transactions within a block, MEV is there. Second is there's natural network effect, and this is probably the first DEX aggregator we see with network effect, meaning more trades going to CowSwap, then you have better chance of cows, and then that saves a lot of money for the traders and lower the cost, then attract more traders and just kicking off the positive flywheel. And also like CowSwap is a very good meme as well. When I think about all the projects building in MEV space, there are two factors I look at. One is, does it minimize the total MEV value? Meaning like, so the number we see on Flashbot dashboards, like, will this protocol actually help to bring that number down going forward? The second is, where does this protocol transfer the MEV value to? There are only 3 participants in MEV Ethereum dark forest: 1 miner, 2 seeker or arbitragers, 3 traders, users. And CowSwap is definitely one of few protocols that just transfer the value back to the user. So whoever that's trading on Uniswap or Sushi or 1inch now, like, and if we're getting sandwich, we're taking some value from by the seekers, like CowSwap is actually directing part of the value back to you and me. So that is a very healthy and good meme by itself. And what's really interesting is on their website, there's a mini game where you can play, and you are like a cow that jumps and avoiding being hit by sandwich. The metaphor is like using CowSwap is helping you stay away from being sandwiched on just MEV dark forest. So that's pretty much it. I'm open to any questions.
I just have not a questions to add something. You know, I've been close to Gnosis because, yeah, DXDAO has been initiated by Gnosis, and Gnosis also, I don't know if you know, they had like this on-chain decentralized exchange called Mesa, and it was about ring trades, and it had like a similar design, but there the trades have been, they had also like you had to put your trades on chain. It was very old school and complicated. You need a lot of transaction, and then every 5-minute resolver has been has then solved find the best price, and the design was for low liquidity coins, because then it makes some ring trades of you. It's quite a complex protocol has been, because now it's defunct. But CowSwap somehow is like, they took the learnings from there and made like a different design. And I really think, yeah, I like CowSwap very much, because it's very easy to use. You just have one, if you use it, you don't have to, you have to allow your token, and then you only have to sign the transaction, and then the rest is done by them. So it's very user-friendly also.
Yeah, thanks for adding that. I do have a lot of respect for Gnosis team as well, just for everything they've done and like contributed to the Ethereum community. And also, like, what's really interesting is when we sign those transactions and hand over to solvers, actually, like, Gnosis has a team of just mathematicians, like PhDs, who are doing the solver job. So they're like thinking of ways to just put your trades at the best place, giving you the best price, and like staying away from being sandwiched and all those. So like, it's definitely very good.
At the end, I have seen the presentation of CowSwap in the ECC Paris. And
nice.
What's interesting is there that at the end, you know, but I think if you look at the design from 1inch, who runs like the solar for themselves, they have like a server farm who looks for the best route and then finds the best price for you. The design of Gnosis, in fact, is that everyone can run a solver. Or the idea is that there's like a public infrastructure. So everyone, also an outside company, can run the solver, and the solver should at the end compete against each other. I don't know if they really, of course, for Mesa, they also had like a solver, but the solver is just run by them, you know. But the idea is that they can outsource this job, and I think it's a very nice product strategy, because then people have an incentive to make your protocol better somehow, you know, because I guess solvers then get part of the fees, or I don't know exactly the
they're getting rewarded by token.
Yeah.
For the
and I think that's a very nice business model, because then you don't have to build everything yourself. You have then other people who are interested in this kind of stuff, and then incentivize to build like a part of your infrastructure.
Yeah, definitely. And it's also a process of decentralization, which they really want. Like probably you can run the solvers yourself when the project first started, but over the time you want to give it away to community and like whoever the best people are at those tasks, and reward them for their work.
Yeah, exactly.
Thanks.
Maybe we see. Yeah, thank you.
All right. Oh, one more question.
Yeah, this is Ruby. Just one more quick question. I know like CowSwap is built upon like Gnosis protocol, and it also have like product like Gnosis Safe and the batch auction. So just wondering how those products is like integrated in the protocol as an ecosystem, and what their plan for the ecosystem development in the long term.
So by ecosystem you mean the Gnosis ecosystem, right?
Yeah, the Gnosis protocol. Yeah.
Yeah. So like CowSwap was founded by a group of people from Gnosis team, but they don't want to stay that way forever. So I think the plan is that CowSwap team is gonna spin off from the Gnosis team as a separate team, and then just build this thing and make success of it. That's the plan.
Okay, got you. Thank you.
Yeah.
I had to add something to this, because the thing is that Gnosis has founded the GnosisDAO. So Gnosis tries to like move. Gnosis has been a company, basically. It has like different places. And now they are moving. You have to look at GnosisDAO. GnosisDAO, they made their own DAO, and they are moving into being a DAO. And they also, they're looking for contributors like everyone, and they have quite a big treasury at the end. But they struggle with the token distribution. The main problem they have, the token distribution of the Gnosis token is not very good, because the main founders have a lot of token, and so government is somehow, I followed it a little bit closely, but the thing is then, if there's a huge stakeholder, two founders have a huge stake of the government's token, this means that at the end, they can kill like every incentive they don't like. And this is somehow a problem, because that's the reason why you need a good distribution for your government's token, because at the end, if then only the insiders or two people have most of the token, then it's not decentralized somehow. But you have to check out their forum, have a look. They talk about CowSwap and all this stuff there.
Okay, I'll go and check the forum. Thank you.
Yeah, I think that's also a problem for the DAO with too much money. Yeah, they raised tons of ETH back in 2017. Just too much money. It's not really a good thing for a DAO, maybe.
Yeah. I think they have a great engineering team, but they had constant like problems building products. Now they got it with CowSwap, but before, this Mesa Decentralized Exchange has been a very nice design and engineering. It's top engineered, but has not been like a usable product. But now with CowSwap, I think they found like a sweet spot, I guess.
So we can move things along. We have about 30 minutes left. We still have a couple of presentations. So let's get Shuyao to go up next.
Hey guys, I am 1 minute away from my next meeting, but I've told them to that I will be late, so I'll be quick with my presentation. And by the way, fascinating discussion around CowSwap, their consensus portfolio, the mesh portfolio, so super bullish on them too. All right, oops. 1 second. Sorry, guys, just make sure I'm sharing the right screen.
If it doesn't work, you can also send Sharlyn your deck on Telegram.
I'm happy to help.
Might have to do that. Hang on. Actually, Sharlyn, I'm just gonna pop you the link on the Zoom chat. Do you see it? I can start while we're getting the presentation ready. So I'm talking about idle finance today. Full disclosure, I am not a degen. I am a pleb, and I will not talk about complicated topic such as MEV, but really just the way how I do my own DYOR. And the reason I'm bringing up idle finance, not only because it's simple and easy and good for plebs, but also special thanks to Rodney, who helped me along the research phase. Again, just another value proposition for AladdinDAO where you actually have people to help you research. Sharlyn, do we have the slides up?
Well, I have a technical problem.
Okay. You know what? I can also just WeChat you this.
Because I can't turn on my VPN. Well, I used to. So I need my VPN for Google. That doesn't work.
Actually, can you see it now?
Yep.
Oh, okay.
Yeah.
I guess it finally worked. All right. All right, so first thing first, this is exactly how I think about stuff when I'm aping in anything. In this case, it's really not aping in, but I would always select a protocol that's audited. I just don't take that type of risk. I don't do testing prod, my own preference. So in this case, idle finance is audited. And then second, the reason I'm thinking about idle finance is really around the philosophy behind it. I think in DeFi, especially for people who are not super deep into the degenerative stuff, it's really about return and risk. So idle finance, I think, strikes a right balance between having both managed risk and decent return. So exactly what is it? So it's a protocol that allows users to optimize their digital asset allocation across leading DeFi protocols. So it's extremely simple. You go on the website, you choose a strategy, deposit your assets, and they automatically rebalance across different lending protocols, leading DeFi protocols, and then you can just get your token back. So from a simple illustrated perspective, you put your money in, it goes and kind of hunt around different interest rate and yields, and then get back to you with a decent return. So far, there are two strategies on IDO for now. The first one is max yield. So obviously, it's just you get more return. The second one is adjusting risks. So it's lower yield. However, it's for those who are more risk averse. And it is in collaboration with DeFi Score. So from an interface perspective, you can see right now it's pretty early. The market cap is 11 million. I think right now, according to DeFi Llama, there's 135 million logged in. So not a super big protocol, but I think it's a steady, stable, good old fashioned protocol for you to keep your money in for longer term. So this is the best yield strategies. And here is the risk adjusted one. So it's only stable coins. So a few days ago, they launched a new product called perpetual yield tranches. So you can choose whether to use senior tranches or junior tranches. And these are really concept borrowed from TradFi. So for senior tranches, obviously, like if there's any hack or loss of funds, you get compensated first. And then if you're in junior tranches, anything bad happens, you don't get it. So again, it's really a play on risk and return. So what are some of the benefits? Again, this is just a plebs perspective. I really hate gas. And I probably get sandwich attack all the time with idle finance. It's batch transactions much cheaper because they actually pull users' fund together in the main contract. So it's really a minimized gas. And second of all, it's integrated with major DeFi protocols. So you really don't have to do it on your own. It harvests and compounds and boosts everything just simply for you. You can also stake IDO for liquidity mining. I think they launched a liquidity mining campaign a few days ago. They might have more upcoming. It's a pretty vibrant DAO community. They are going on Polygon, so it's not just on the mainnet. And then with the perpetual tranches, it's permanent yields. You don't have to worry about epoch. And lastly, I think there is some value in IDO. You can use it for governance, which is probably empty promise for now, but in the future, you can also earn a performance fee. And lastly, what I would say is that if you can, farm, harvest, and compound yourself, this might not be the right thing for you. But if you're lazy and just want something easy to park your money, this might be the right place for you. And lastly, IDO is a community and DAO. I spent some time on their Twitter and on their Discord. They're pretty active. They're going after institution. So for those who know, Compound and Aave are also really heavily after institution because, again, these are like simple, easy yields for institutions who are earning, 0.001 yields right now in TradFi. They're also partnering with Nexus Mutual on the insurance space, Biconomy for simple frictionless deposit, and lastly with other DeFi protocols. So that is my presentation. Any questions?
Yeah, that was super awesome. Thanks for presenting that. I think you put it into good terms. I like that it's a pretty simple protocol and it's not super hard to understand or anything like that.
All right, thank you guys. I might have to hop off, but
yes, when you don't get questions, that means you get all the votes.
No, it means that this is too easy and not controversial at all. So people are like,
Just everybody get it straight away. That's cool. Thank you so much, Shuyao.
Thank you, guys.
Yeah, at least the risk-adjusted idle yield is higher than comp yield, so it does make it a pretty attractive yield option for people who want to integrate some safe yields.
Yep.
I think up next we have Chao.
Yeah, I'm here. Let me share my screen. So can you hear me, right?
Yeah, we can hear you.
All right, cool. All right, today I'm going to introduce ARCx. It's a project still at a very early stage. A little bit for myself, I'm Chao Wang. Most people know me as CEO of BitPie Wallet, where I spent many years there. I have left BitPie and shifting my interest to community-driven projects since last year. Now I'm working with some community members to start a research DAO. All right, let's begin. So ARCx is a scoring protocol. They issue DeFi passport to their users and allowing users to unlock benefits through their on-chain behavior. They are processing a large amount of on-chain data so that they can build a model to generate score. This project is funded by Kerman. He's also known as founder of DeFi Weekly. The team is still very small, less than 10 people, and they have 2 data scientists on board who are the key to their scoring system. This project started from August 2020. Well, actually, the original idea is to build a governance minimized central bank. They launched StableX. It's a stable coin, and the protocol issue credit against other DeFi assets through the StableX. They did very good job on fundraising. They got about $9 million in 3 rounds, and there are some pretty big name on it. But the project didn't go well in past years. I think the first 2 versions of ARCx didn't get many users, and they decided to change their focus to a DeFi scoring system, and that is ARCVC. All right. So the DeFi passport is a NFT and comes with a credit score. The credit score is not a frozen score and can be changed from time to time. To apply a passport, and user need to stake about 250 ARCx token for a year. And also there will be a address screening to determine if good for a passport or not. The passport V1 is already launched 3 weeks ago, but credit score is not included in that version. Next, they are going to launch Passport V2. It will come with the credit score. That score will be calculated, I think, based on the on-chain behavior. Good borrower will get a higher score. And higher score means you can unlock some benefits such as maybe exclusive farming ground or better collateral rate. And they are also going to launch another stablecoin, ARCUSD. It's a new borrowing and lending platform. I guess it should be a showcase about how to integrate credit score in the DeFi protocol. After that, they will work on bringing more score to users, such as yield farming score, airdrop score, governance score, trader score, nav score, and more, maybe. Okay, loot. In past 10 days, everybody talk about loot NFT. Well, in MMORPG, you beat dragon, you may got a ring or maybe other rewards. Then you get respect, you get stronger, and you'll be able to beat more dragons. So in my point of view, the scoring protocol is it's like a evaluation system to do loot distribution for the Ethereum ecosystem. You behave nice, you show your support to innovation, you survived from rug pull, hacking, and all those bad things. And then entire ecosystem reward you, maybe not immediately, but sooner or later. When you use Uniswap 2 years ago, you don't know you will get Uni as a reward. So when you donate on Gitcoin at very early stage, you don't know you will get a lot of airdrops. And now maybe you are participating in many DAOs and vote for good things. No one is rewarding you for that. But that doesn't mean you don't have a reward. So no matter in game, in real world, or in crypto world, I think every step counts. And what ARCx is doing will help the ecosystem to counter their step. So the user can unlock their hidden reward and also empower other protocols to build scenario on it. So that was my understanding about this. Okay, last is the risk. I think the biggest risk may come from the team. Making a score system need a lot of R&D resource, especially in a very hard way, maybe machine learning, AI, but their team member is not as strong as we expect. They keep hiring new talent, but until today, it's still a very small team, and team members' record is not convincing enough. A second is maybe from the privacy and data modeling. A lot of people tend to use new address for each project due to privacy or security concern. So that may make it very hard to calculate score for those people and also impact their data modeling. Good thing is all on-chain data are there and free to use and get, but those data may not be rich enough, and DeFi world is changing so fast. So it may not be that easy to build a strong scoring system. And lastly, I think is how to build the network externality. I think it's really, really important to make other protocols to integrate and design a lot of new scenarios for passport holder. But when you go out and talk to other protocol, they would like to know 2 things. One is your scoring system actually worked. The other is how many passport holder you have. So I think it's really a bad idea to force people to stake ARCx before they can apply for passport. They opened batch 1 passport apply 3 weeks ago, and the 1,000 slot were gone in 2 days. They are very, very exciting about it. But I think that's mainly because we are in an NFT bullish market. So a lot of people think the batch 1 passport could be considered as the Genesis version. That could be valuable. So I think that's why they are applying for the passport. So 1 week later, after batch 1, they opened another batch for 1,000 slot, and 10 days has passed, only 200 people apply for it. So I think what they want to do is deliver the scoring system as fast as possible and encourage as many as possible people to apply for it. So forgot about the staking, and that's not really not important at this moment. So overall, this is a very early project. I think the direction is promising. I like it, but it's also too early to say who will be a winner for this racing track. All right, that's all I have today. Thanks.
Sweet, thanks. I have a question. So what are some of the viable ways you see that like a DeFi passport like this could be used? Like, do you like, are you scared of the risk that people might, create different wallet addresses and participate in protocols ethically just so they can like increase the amount of like, under collateralized borrowing they can do and just like, force attacks that way? Or how do you see, I guess, this being part of like some sort of pivotal DeFi infrastructure in the near future?
Well, I think they have a lot of work to do. At this moment, they have not proved their scoring system works. Actually, they don't have a scoring system yet. So that's why they build ARCUSD. They want to have a showcase to show it can work. But is that actually works, or is that bring more security issues? I don't know. Maybe. So that will be more work to do there.
Yeah, that makes sense. If no one else has any other questions, we can move on to Jeff.
All right, I'll get started then. Let's see. Okay, here we go. You guys see that one?
Yep.
Okay, yeah. So I'll be talking about Abracadabra.money and kind of the analysis framework I use to look at unaudited projects in DeFi and whether it's investable or not. So at a high level, I want to figure out what this protocol is doing. And basically, they're a DeFi native lending platform. So you deposit in interest-bearing tokens, and then they mint you their own stablecoin, Magic Internet Money, or MIM, which offers both composability and leverage. So they have a governance and profit-sharing token, Spell, and they've also done a multi-chain integration. So yeah, Binance Smart Chain, Phantom, AVEX. And basically from like a quick overview, I can tell that like it's already going to be pretty useful, right? Like people want leverage. People don't want to just park their stablecoin somewhere and not be able to use it, or, volatile collateral. So we can look at the growth of the protocol as well. we want to see that people are actually using this, right? So first you have TVL. It's actually up to about 400 million now, just on Ethereum. The volumes of the MIM token as well as the spell token, and then also the number of users, which we can measure through like wallet addresses. This is from Nansen, but you can also find it on either scan. So next we get into like why does anybody want to buy a spell, right? So the value accrual mechanism is that, well, you stake spell for a spell, and then it's very simple, right? The interest fees and liquidation fees automatically accrue to that. There's no claim function. You don't need it basically auto compounds there. The treasury can be used for buybacks. They posted a couple already, and then they haven't launched governance yet, but you have that optionality. So essentially for this this token to the value accrual to offset the inflation rate, they constantly need to be growing the TVL and need to be issuing loans. Yeah, so we also want to look at the tokenomics. And as we can see, most of the tokens are reserved for liquidity incentives. The first one is the MIM curve meta pool. This is definitely important because you need to, a third-party way to stabilize the peg. Team allocation is pretty normal. And then you have pool 2, which is also quite important because you need to incentivize people to basically provide the depth so the spell isn't just completely volatile all the time, right? It has to have some sense of tradability. Some other security notes. I want to see who's the contract owner of this token because it is anonymous and it is unaudited. So we can check that it is actually a Genosis safe multi-sig, and I think it's like 9 people with who are all like top-notch devs in DeFi projects. So we can check that the actual code implementation there. We also want to look at the distribution of these tokens. So the first one is the largest holder is actually the contract itself. So to execute this burn, they sent the spell token to the contract address. And we can verify that this contract in the code doesn't have external payable functions. So this the spell sent here are essentially burnt. They did that instead of using the 0 address. Number 2 and 4, I dug a little deeper. These are actually used for team payments. And so the top holder essentially is the staking contract, which is good, right? You want people to be staking their spell as opposed to just dumping it on the market. So we also want to see what MIM is, and that's their fully collateralized USD stablecoin. So to ensure that this stablecoin is pegged, we need to understand every function that affects it. So first we have the mint. So you can actually see that most of the MIM is held by the Sushi Swap bento box. And in order to call the borrow function, collateral needs to be already deposited into their Cauldron contract. So only the Cauldron contract can interact with the bento box and take out MIM. So, and then to redeem, you can only repay in MIM as well. And they also have the, number 2 is the curve meta pool. So this is like the external way for MIM to be stabilized at 1, right? I think they're at like 300 million now, just in curve. So if it goes above 1, well, you just sell it, right? And then below 1, the borrowers are incentivized to actually buy it and then repay their loan at a discount. So it's a very simple arbitrage mechanism and effective thus far. So I also will do like a full code review. In this case, the Cauldron contract is forked from the Sushi Bento Box V1. This one has been, it's well used and understood. You definitely want to, check anything that modifies state, any external functions. They haven't really changed too much here. So yeah, I'll look at their code on GitHub, what's deployed on Etherscan. There's a couple other diff tools out there. And also interesting to note that in the protocol, MIM is hard coded to 1, right? So even though somebody can try to flash loan from the curve pool and unbalance it, you can't take that MIM and then go and repay the debt just because they've hard coded to 1, right? So it is a pretty simple mitigation there. So looking at the competitive landscape, there are other protocols with similar functionality. I would say Spell is more interesting because it's just simple and straightforward, right? You don't have to borrow USDC or Tether. You borrow their own, their native currency. It's extremely capital efficient with like between like 70 and 90% LTV, depending on volatile collateral versus stable coins. Also better interest rates. The USDT vault was like, it's like 0.8%. And then, very gas efficient as well. So I'll go into that a bit next. Basically, we have two strategies here that we can do. If we believe that in the long-term value accrual of the Spell token, we're just going to buy it and stake it. Very simple. And obviously, I mean, there's been some price speculation as the TVL grew in August. And option 2 is if you don't want the directional market risk, you do the leveraged stablecoin farming, which is the protocol's intended use case. So in this loop, you could deposit USDT to Euro V2, and then you take that IB token, deposit to Abracadabra, borrow 90% in MIM, and then deposit it into Curve, and then stake it on Convex. So, and there's also a mechanic where Spell is being used to bribe VECRV. So it's like boosted CRV plus CVX plus Spell, which is like 40 or 50% APY. Alternatively, you can do the recursive farming, and they actually have like a one-click function for this. So you don't have to do all this manually, right? You can deposit the USDT into Yearn. The Yearn goes to Abracadabra. You borrow the MIM. The MIM gets swapped back into USDT, and then they re-enter that loop, right? So you can get leverage on this with one click. Very simple interface. And so that's all I had. Can open up for any questions.
Anyone have any questions?
Yeah, that was fascinating. So what sort of yields can you actually get effectively using the leveraged stablecoin farm?
Well, for example, right now, the boosted curve convex is 40 to 50%. The recursive farm right now is probably not as interesting just because the Yearn vault is not super high. So it'd be like, maybe like 15% or something. But yeah, so it's good that you can use this in other, basically, you park your stable coins or your X Sushi or ARCx there, and then your borrowing rates are very low. So it does allow for a lot of leverage.
Very cool.
Yeah. So Jeff, how you look at it from investment perspective? I think it's quite similar to like a chemistry, the ARS USD, and it's just within the wide earn sort of ecosystem, and you see that Coinvex as well. This kind of interlocking liquidity, LTV, double counting, etc. But do get a pretty good sort of market validation in terms of market cap. So I mean, in general, how do you view this kind of a perspective from for example, like the wide earn system or ecosystem projects, or some of the projects that actually maybe from a founder's perspective have some association with the wide earn sort of ecosystem. I think that's something that is not really like quantitative analysis, right? Something I think from a liquidity mining perspective or investment perspective, probably it's more like it's more like a name play or something like that. I'm not sure how what's your view on that?
Yeah, so I mean, they outsource their yield to Yearn in this case, and I guess it is like a DeFi native protocol, right? So they kind of want to fit in with all the other fair launch protocols. The differentiation from Alchemix is that it doesn't need to be over collateralized. And then it basically creates a composable layer on top of Yearn, right? So like Yearn is your kind of lazy algo yield harvester, and you know it's pretty safe, and they have a huge amount of TVL. But what if like you don't want to just park your assets there and you want to do something else with it, right? So
yeah, but I think for this kind of sort of project, when I look at it, it's actually, it all depends on Curve's sort of incentives, right? It's built on Curve's incentive, like Covex, right? It's the same thing,
right?
So the whole value sort of deprived from Curve, and I think that's also an angle to look at this kind of project, because when I look at meme, the first natural question coming to my mind is, why the heck Curve would give such incentive to this pool? It's so large, right? And what's the point for that? And what's the rationale for that? I can't find an answer, except that they probably have some association with the founder team of Curve, or some kind of relationship.
Sorry.
Yeah,
I can answer this because
Yeah.
I'm a Curve boy. The thing is, the distribution of the Curve, it's voted. So we Curve holders vote for the distribution. There's like epochs, and then there's every week there's a vote how the future, the curves earned in the next epoch are distributed. And then we Curve holder vote for the different pools. And so it changed. This is the reason why. And the thing is, what they did, there's a project, and Nicole wrote it 2 weeks ago, and it's called bribe.curve fee. And there they put out a high incentive that if you have a V-curve, and I got some, then you can vote for meme and get almost, I think it was like around 1,000 for me, because it depends how much you have. But it's not that the Curve team is they don't do the voting. The V-curve owner do the voting. Just the simple way. So there's no connection. At the end, there's no connection to Curve team, because now even Curve is going in the direction that you can self-list, as everyone can list pools.
I mean, I think that my point is, if actually look at this category of investments, right? There's one angle to look at it, like Convex as well, right? So you've actually built a protocol that highly integrated with Curve. You likely get the V-curve vote, and you likely can derive a lot of value out from this, right? So this is something that when I look at this opportunity, I say, okay, this is some of the Curve kind of project, and you can derive the value from there, because at the end of the day, you will get incentive from Curve, and you will have a market cap on that, right?
Yes. The Curve is in the middle of like a lot of projects at the end, and I don't know what happens if Curve emits this Curve token for the next 4 years, and then I guess they stop. So I don't know what's then going to happen to all this project.
Yeah, I mean, it is. This is definitely like speculative. So like if you do collapse the token price of Spell and then remove all the incentives from the curve pool, well, essentially you have a very weak use case for like providing liquidity to the curve pool, right? People want the APY. So
yeah, I enjoyed your project, your presentation, because I missed it somehow. I did shortly look and was thinking, 2 weeks ago I looked at the project and I was thinking, this is just another, it's like, you kick it off and then it blows up, and after 2 months it will go away maybe. It's not going to happen with this one, but because I think it has a use case with like,
yeah, so from a risk management perspective, yeah, we definitely want to keep an eye on the depth of the curve pool, as well as the
because
price of
the
Spell.
other token I've been following has been DAC. The DAC token, they have like USDN, USDP they generate,
Right.
and they did like a similar thing, but a little bit simpler, and it's very similar, but there you just use normal coins to generate a stable coin.
Yeah.
Okay, thanks.
Sweet. Looks like that's everyone from our group. Sharlyn, would you like to close things out then?
Yeah, I think this has been very impressive session. So everyone has done awesome work. And I think big applause for everyone. And especially for our host, Rodney. So we look forward to next session tomorrow, and then we'll head into liquidity mining and then BOOL election process, voting process in 2 weeks. So anyone else have any questions? Mindao and Martin, thank you for being, the big question guy. Thank you for asking some questions.
Yeah, you're welcome. So have a nice day. Bye.
Yep, I think that's for today. And thank you, everybody.
Thank you all. Yeah.
Thank you.
Bye.
Bye.